Thanks, Ed. So everybody watching the news and reading the paper is wondering what in the world is going on in the retail market. The theory or the theme that we've really been seeing begin to take place in mid-08 and has continued into 2009 is survival of the fittest. The strong are continuing to get stronger. Now, landlords with well-positioned centers and strong submarkets with a good tenant base continue to do well. Retailers that have a strong balance sheet, strong management team, and those that were disciplined in expansion when the retail market got so hot, they're not only going to survive, but they're going to thrive. So let's get right into it. How we got here. Really three economic factors that have had a negative impact not only on the retail environment, but on the overall economy, and the first is energy costs, this being with higher food and higher fuel. Secondly, the housing crash. Now, at its peak, the housing market was generating an approximate $800 million a year to consumers in the form of a home equity line of credit or through refinancing. And lastly is the capital markets. Now, what these three factors have impacted is somewhat of a trickle-down effect in the retail industry, and it started with job loss. Now, the current unemployment rate is hovering around 7.4. Find out tomorrow where it's upticked to, but currently sits around 7.4, and that's an all-time high. Highest level it's been since 1993, I should say. What this has led to is less disposable income for consumers, leading to lower sales, and ultimately, store closures. Now, you look up here on the screen, you see some of the most prominent names in retail. Circuit City, Starbucks, Linens and Things. They've closed hundreds, thousands, some of which have liquidated their entire portfolio last year alone. Now, retail accounted for 144,000 store closures in 2008, and this is a 7.5% increase from the previous year. But most people have seen this in the news and on the paper, so what we want to do is take a look at where they went wrong. Undisciplined expansion and undisciplined underwriting. Now, since the last downturn, there has been a tremendous amount of expansion and development. Now, at the beginning of this cycle, retailers, lenders, and landlords alike were much more disciplined in their approach. However, money became a little bit easier to come by, saw some greed enter the equation, and Wall Street began rewarding these retailers for these overexpansion plans. What came about eventually is retailers threw their expansion model out the window and began expanding solely for basically the sake of expanding, regardless of what it was doing to their bottom line. Landlords and lenders, riskier underwriting. Lenders began giving the developers money solely to support this excessive expansion, regardless of the fact a lot of these locations would be considered secondary locations. Now, we eventually got to a point, the last couple of years, where the rents that these retailers were paying and the rents that were being underwritten by developers and are assumed by the lenders were not correlating to retail sales. They were instead correlating directly to construction costs. Due to the downturn, retailers got a little over their head and they could no longer support these operations, and you inevitably saw the aforementioned store closures. So that brings you up to speed on where we've been. Now let's take a look at some of the trends we're seeing today. We're going to really hit on three trends. The first is consumer confidence. Most of you know consumer confidence is at an all-time low. It continues to plague the retail industry, and it's driving retail sales down to the ground. To make matters worse, consumers all across the country have seen a huge decline in real estate and stock market wealth, and it's absolutely devastated nest eggs. Now, what this is forcing individuals to do is to get back to the old traditional way of generating and accumulating wealth, and that's by spending much less and saving much, much more. So this change in consumer spending, or this change in consumer savings, has really brought back to life this theory of trading down. Now, it's not a new theory. It's been around for decades. Traditionally, this trading down theory had a counterpart, trading up. And what I mean by this is over the past decade, many consumers have really split the market and stopped focusing their purchases on middle-price retailers. They've instead focused on luxury goods and discount goods. We're now to a point where consumers are getting much more cost conscious, and not only has there been a mass exodus from the mid-price retailers, there's been a huge flight from the luxury good items. Now let's look at an example here. We'll look at two department stores. First, TJ Maxx. Most people realize it's a discount department store. What you probably didn't know, though, is TJ Maxx, despite the uncertain economy, was able to manage a 1% increase in sales from 07 to 08. Conversely, Nordstrom, luxury, viewed upon basically as a high-income department store, suffered an 8% loss. Nordstrom wasn't the only one in the luxury category. The luxury chain category overall suffered a 17.5% decrease in sales. Now lastly, the last theme we want to look at is consolidation, and this really gets us right back to the overall theme of survival of the fittest. The strong continue to get stronger, and the weak continue to fall to the wayside. Best Buys, Bed Bath & Beyond of the world are doing absolutely nothing more than having to outlast their competitor. Now again, this is a trend that we saw really beginning to take shape in 08. It's carried into 09, and we feel strongly that this is going to be a major trend that you're going to see for years to come. So let's look at what to watch for in 09 from a landlord's perspective. Undoubtedly going to be an uptick in vacancy due to the store closures and the filing for bankruptcies. What this is going to result in is downward pressure on rental rates, and owners are going to have to get a little bit more creative and a little bit more aggressive in order to get a deal done. Retrading. It's not going to just be with new tenants. Existing tenants, we're seeing it now, are going to be coming back to the table, and they're going to be looking for some sort of concession or a relief in order to help them weather the storm. So how do you cope with this, or how do you survive as a landlord? It's crucial that the owners and the management alike take an active approach and find some sort of a middle ground to try to fend off these store closures and to address issues before they become insurmountable. Find and keep the tenant and make the deal. And lastly, for those owners who have vacancies or will soon have vacancies, despite what you hear, there is hope. The fact of the matter is there are several avenues you can go down as an owner to begin targeting these new tenants. The first is a direct competitor. Whether they're not in the sub-market or whether they were outpositioned in the sub-market, look for a relocation opportunity. Secondly, tenants that aren't existing in the marketplace. Staples, Books A Million, and there are a handful of others that have shown an interest in St. Louis but have not yet made the move. There's no better time than now. And lastly, alternate uses. So from a retailer's perspective, what can we expect to see? I don't think it's any surprise to anyone that retailers have taken somewhat of a defensive position first quarter. We're going to see it in second quarter, but what we believe is you're going to continue to see some sort of a defensive position second quarter with it picking up third, fourth quarter. However, these are really solely going to be the tenants that stuck to a disciplined models and those that are benefiting from this trading down theory. There's going to be great opportunities in centers, submarkets, and they're going to see rates that haven't been seen for many years past. So what's the takeaway from all this? Well, it's simple. The strong will not only survive, but they're going to continue to prosper for several years to come. I thank you, and I'm going to turn it over to Marlon. She's going to address sustainability.